Joining us now is Ksenia Galouchko, Bloomberg Equities editor, to tell us why this is happening. Certainly, we've only had a few trading sessions this year, Ksenia, but if you just look in normal percentage terms, Europe has outperformed the US so far.
Absolutely, Matt. Yes, it's been a stunning outperformance. So since the very end of September, Europe has outperformed the US by a lot. And it's not just in local terms, but also in dollar terms. And the main reason here is China's reopening and also the abundance of value stocks in the European market. The US is primarily suffering from the huge impact of mega cap tech stocks really weighing on the S&P 500 performance here. If you strip out the tech, the S&P would be performing the same way Europe has.
Ksenia, good to see you this morning. So there are clearly lots of reasons why a lot of investors are getting excited about European stocks. China reopening is one of those, and a lack of exposure to those vulnerable tech stocks perhaps also. But when you talk to macro strategists, a lot of them talk about how the ECB is going to hike more this year than the Fed. And I wonder how much of a headwind that could turn out to be. We're just hearing from Isabel Schnabel of the ECB. She's saying policy must turn restrictive to fight inflation. Inflation will not subside by itself. So keeping up the hawkish narrative, and yet we're still supposed to see the upside for European stocks.
Absolutely. That's the really interesting dilemma here. So this morning, Goldman Sachs economists came out and said that they're no longer expecting a recession in Europe this year. Earlier, they were expecting a small contraction. And this is mainly on China reopening coming in sooner than expected, and also gas prices coming in lower. So the energy crisis is not expected to be as strong. Again, this means that ECB is likely to continue hiking higher, and Goldman economists confirm that. But at the same time, just like I said, the abundance of value and cyclical stocks and lower valuations in Europe are likely to continue driving the outperformance in European equities.
Do we continue to see outperformance in European equities that are so reliant on energy companies if this winter stays warm?
Well, it's not just energy companies. If you look at the sectors that have been outperforming the most since the end of September, it's actually banks and consumer companies. So luxury it has been doing great. And as you know, luxury companies are some of the biggest in Europe. Take LVMH, Kering, some of the biggest outperformance on this China reopening. At the same time, yes, energy and commodities have actually been lagging behind this year as gas prices, oil prices are starting to subside. And banks, of course, benefit from those rate hikes that are expected from the ECB and the Fed.
And over to US stocks then, Ksenia. I mean, Morgan Stanley's Wilson is saying don't buy US stocks in this any latest bounce. He says that we could see a 22% slump from current levels. Goldman's Costin also seeing the 2023 earnings story as showing estimates are too high. This doesn't bode well stateside, I guess.
Well, so I was looking at the Citi Earnings Revisions Index the other day, and actually the deepest cuts right now compared to Europe, compared to the world, are for the US market. So I think analysts are going into this season very pessimistic, and that way the earnings can actually outperform their expectations. That often happens. So currently the rate of those earnings cuts in the Citi Revisions Index is the deepest since early 2020, since the peak of the pandemic.
That's really interesting. Yes, so a bit of catch-up maybe a bit happening there in terms of estimates from US analysts. Ksenia, thank you very much. Bloomberg's Ksenia Galouchko with the latest on the markets.